For the first time in 4 years, the Swiss real estate bubble index fell from 0.95 to 0.82 for the first quarter of 2012. I'm joined down the line today by Matthias Holzey, real estate analyst at UBS, to discuss the index release and what the results will mean for Switzerland. Mr. Holzey, thank you for joining me. The UBS real estate bubble index was out late last week. What did this index show and what do these results mean for the real estate in Switzerland?
Well, as we mentioned, the index dropped from 0.95 to 0.82, and this is, on the one hand, really the first strong decline since 4 years. And I could say that this indicates that the market has cooled off slightly in the last quarter. But also, I would, on the other hand, say that this index move should not be overinterpreted, as the market, well, maybe surprisingly, did not reach the risk zone, but I mean, it's still in the upper part of the boom zone and could rise easily again in the coming quarters. The reason behind the decline has been that none of the sub-indices gave us positive stimulus to the index. The most important factor has been a drop in asking house prices in combination with rising household incomes.
Do you feel the decline of the index shows a turnaround in the real estate market?
Well, definitely not. I mean, easy financing terms, high population growth, and the robust growth in the domestic economy keep demand booming. And if we look also at construction, then we see that the market is still undersupplied, especially in the Lake Geneva and Zurich regions. And we see that the construction sector is working to full capacity, but nevertheless, there are still less housing units coming to the market than in the 80s during the last housing bubble. So we can be pretty sure that this does not mark the beginning of a turnaround in the Swiss real estate market.
Zurich, Geneva and Lausanne have experienced the sharpest price rises. Why are these areas most affected?
Well, the reasons are pretty simple. I mean, these regional economies have been booming very strongly in the past. Zurich, Geneva and Lausanne showed very strong employment and population growth. It was being fueled mostly by immigrants and mostly by high-income immigrants. And this in combination with the sluggish supply growth, as I mentioned before, then rising house prices do not come as a surprise again.
Can the central bank do anything to combat rising house prices?
Well, the central bank, first I have to say that the loose monetary policy of the central bank is mainly responsible now for any further rise in house prices and rising mortgages. What they did now was they pushed for the introduction of some new minimum requirements for mortgage financing, which has come into force on 1st July, so that people need at least 10% hard cash, which cannot be taken from retirement savings. And furthermore, they can propose the implementation of a countercyclical capital buffer, which would be up to 2% of risk-weighted assets of banks. And this would make mortgage financing more expensive and therefore should give hand to a rise of mortgage rates. But I would not expect any of these measures to have a strong impact on the market. I mean, if they want to become really serious, then they would have to rise interest rates, and this is politically not feasible at the moment. So I would say that nothing will happen from this side.
What are your predictions for the Swiss real estate market as well as the UBS bubble index for the short and long term?
A further moderate price development would be welcome for the market as it would reduce the risk for price correction. But personally, I would expect to see the index in the risk zone at the end of this year already. And, well, the longer term predictions are mostly conditional on the development in Europe. So if interest rates stay close to zero, then real estate will gain further in value. And if not, we'll see probably some price corrections, at least in the current hotspots in the Lake Geneva regions.
Thank you for discussing this with me today, Mr. Holzey. That's all from me, but click back to the website for more interviews and updates. Goodbye.